I think most of the rent versus buying calculators are wrong because they don't show you this one number, which is the most important number in order to compare apple to apple. And I'm going to show you that and tell you that maybe owning isn't always the best. Maybe sometimes renting is good. And I'll give you my conclusion on what year, how long like renting is good or how long like owning is good. And I'll give you my personal opinion. Hey, welcome back to my channel. This is Shawn, the Realtor guy from Portland, Oregon. So the calculator that you see on the screen, one on the left is the rental, one on the right is owning. I ran the number on $460,000 home, which is my listing in Milwaukee right now that's available for sale. I used its property tax and putting 10% down. So one on the left basically says that home is going to rent for about $2,400 a month. And if you pay that for the next 5 years with a 2.5% rent increase annually, it sums up to be $151,382, which is on the red color. Same home, you put 10% and you bought it, the monthly payment is $3,681 a month. That's including property taxes. Now, the other number, the 46 is what you have to put as a down payment. 26,450 is the principal reduction, which means that you're paying off of that loan on the principal. It doesn't show interest. Interest is very expensive. Let's focus. And 3.5% home appreciation annually for the next 5 years. So basically this green number is the $158,786 is three numbers above that combined. Now, this is why I decided to make this video. What they don't show is how much you actually pay every month. Do you see that $36,881? That's monthly payment. Where do you see that number accumulate into 5 years? The total amount of 5-year payment? There's nothing. This is why I'm kind of embarrassed as a realtor, and I think that this is kind of deceptive in my opinion, because me as a consumer, I want to see that number, right? Now, I hope this calculator works here. Oh shoot. Let me restart that. I don't know why that is, but restart capturing. Hopefully you can see this. Yeah. Now you should be able to see. Yeah. There we go. Let's not change anything. 3681. That's every month times 12 months a year times 5. That's how much you pay. This is a number that the calculators like this online, they don't show. So you're basically spending about what, $1,300 more? Yeah, almost $1,300 more when you own. And some say, hey, I could invest it into like S&P 500 and make a lot of money. And I think you could if you're disciplined enough to put all the savings into an investment account. That actually could be a good thing to do if you are, like comfortable, investing in stock market. And if you know the stock market better than real estate, that might be the way to go. So this is a huge number that people don't talk about. These calculators don't show, which is a problem. And on top of that, you have to add that $46,000 because that's the amount that you brought in as a down payment, which is your money. So you have to have a lump sum of $46,000 in order to buy a home. So really in 5 years, you spend $266,860, which it doesn't show anywhere on this calculator, which is the problem. So that's the baseline. That's one of my main key points that I want to share in this video. And let's see in 5 years, if it makes sense to buy this house or renting is better. And I'll give you one other conclusion after that. So this is how much you paid, but you're getting the equity appreciation. Now this is where it gets a little bit tricky. It says 3.5% appreciation, but in 2026 we could have negative 2% appreciation this year. No one knows. But this is averaging out what happened in the past. But we're just gonna go with just 3.5% appreciation. Sorry. And see if we can have some, apple to apple comparison. So out of what you spend here, minus 86, is it 336? Yeah, 86336. So it kind of goes down how much you spend because of the home equity, and then you pay down the principal of 26,450 minus 26,450. So it comes down to $154,074, which is very similar to the rent payment. That's the other point that I wanted to make. So it's almost break even if you just look at the pure money spending. Now, if you as a renter, if you invest that difference of $1,300 into an investment account, you're way ahead at this point. Do you follow me? So this should be the real comparison. And there's some other arguments about tax savings and all that, but let's just look at this simple number. This is simple apple to apple comparison. So when somebody says buying is always better, no, that's wrong. If that person is going to live in the city for maybe 3 years and move away and they don't want to be the landlord, it's better to rent. If somebody say, if you're going to own for 5 years, owning is always better. Not really, based on this. It isn't. Especially if the difference is invested in investment account or use that money. This is what they call the opportunity cost. They could use that money to buy a laundry machine, laundromat. They could make money, right? Then renting is better. I'm going to say it. I'm a realtor. I've been selling for 18 years, and this is reality. Now, this is more obvious for me to point this out because of the high interest rate right now. Because of the gap is so big. Rental makes sense in some cases. Let me point out some other points here. Now, if it's more than 5 years, maybe year 6, 7, and 8, by that point, with this number, owning will slowly start getting better because you're going to get more appreciation, more than 86,000, and you're going to have a bigger principal paid off, which will be maybe close to double, right? And so you end up getting more, assets that the home is going to give you more benefits. So with these numbers, owning for more than 5 years, owning is better. And you're going to recoup some of that, the money you spend, right? You're going to recoup more while that money is gone. Some say it's down the toilet, and that's what it means. There's nothing to recoup from other than the $1,300 a month savings that you invested into something else. Hope that grew into something substantial. But other than that, that rent money is completely gone. That's the problem. That's why in the current 6% interest environment, you need to run the number with the mortgage payment times 12 times how many years you plan to stay there. That number has to be plugged in to comparing calculation. Do you follow me? And so, in my opinion, there's one more variable One more variable is interest rate. Let's say you bought this house at 6% now in 2026, but what if they actually like 1% lower the mortgage rate in the next year and you refinance that? Then the 5-year balance not benefiting either one, that could tip over down to maybe 4 years, because the 1% saving is typically equates to 10% purchasing power, which means I don't know if I can do that math that quickly here, but 10% money saving could be $370 less. So your monthly payment is going to be somewhere in like 3,200 range. And if that's the case, buying looks a little bit better than renting, right? And so that's other possibility, but it's not guarantee, and nobody knows what's going to happen with that. But based on this number, 5-year mark is where it's not clear which one is better. But when it comes to 5+ years in the current 6% and the current median home price range, if it's more than 5 years, owning will be better. And yeah, I mean, I had a little bit of eye opening here too. I didn't think that the gap is, making the home ownership this difficult. But the home affordability is still an issue because of the high mortgage rate. But one thing that the other thing that I want to point out is that rent is going to more likely continuously go up. Some say that because of the depopulation, people are getting deported, we're going to have less. No, that's not the case. In my opinion, United States is where people want to live, so more people will still come. Demand will be still there, maybe a little less demand. Maybe it's not going to, the rent is going to go up as high as like 10-15% in the last few years. But it will more likely gonna go up just because of the property tax is gonna continually go up, and insurance costs gonna continue to go up. So that's where you're going to bleed your money in. And the other bonus point of the owning home is that 30-year fixed is not going to change, which means that amount is going to feel much less 10 years from now because of the inflation. What you can buy in today's market with 3681 is going to be, in the future, 10 years from now, it's going to be much less. Do you see what I mean? What's like laptop? Let's talk about laptop. Very high-end laptop for $4,000 today. That laptop's gonna be in 10 years more likely, I don't know, $6,000, $7,000. So today's dollar at $4,000 isn't going to buy that laptop 10 years from now, which means the money value is much lower in the future, and you lock in on that. So the longer you own, the better deal it becomes. That's why owning at fixed rate is like, it's nothing that can beat it. It's one of the few instruments, the asset class, that the regular people like you and me can take advantage of as a leverage, So yeah, I cover a lot on this, but yeah, going back to comparing rent versus buying, always plug in that monthly owning payment, multiply that by 12, multiply that by how many years you think you're going to stay, and compare like that. Hope that makes sense. And I wanted to share this so that you consumers have a more clear understanding, because without considering that number, it's wrong. It's completely wrong. So yeah, if you enjoyed the video, please hit that like button and subscribe. If you have any questions in like Portland, Oregon market, give me a call at 503-515-4499. And if you're thinking about buying versus renting in the Portland, Oregon market, I'll be happy to do a 20-minute consultation with you at no charge. I'll break it down and I'll tell you exactly what I told you in this video, but in more customized number based on your specific situation. So have a great day. See you on the next video.